one more for me.
Yeah.
Okay. Referring back to the project that we need to do, right? I know one of the elements in that project is that you want us to choose a model that we're going to use to value the company and be able to explain why we want to use that model versus another one. Like if I'm thinking about doing Coke, which I am, I know that they might have multiple.
I'm disappointed. Yeah. I wouldn't have imagined you to do Coke, but if you insist, and you've now admitted it not only to us publicly, but it's going to be recorded on YouTube. So go ahead.
Why did? Never mind. That I don't know why you say that, but I want to know, like, when going into the, like, trying to explain, like, why I'm not going to use APV, or maybe I do use APV, right? That I would need to explain, oh, yeah, well, this company has lots of different cash flows that would need different WACs, but I'm going to do something different because, or must I do that because it, most companies do have various different ways that they might bring in income and cash flows.
So that's interesting. So I think Coca-Cola is a great example. They are essentially in a singular industry. Oh, sure. They have soda. They have healthier drinks. They're invested in less healthy drinks than Coca-Cola, which, if you can imagine such a thing, right? They're invested in other food services as well. But essentially, this is the convenience popularized food and beverage industry. And that industry, while it may have separable cash flows from separable business units, almost certainly has a relatively homogenized discount rate and expected return. And when that's the case, you can homogenize or just aggregate the cash flows without using aggregated models or aggregating multiple models. The only time you would use multiple models and then add the outcomes up is if you not only have separable cash flows, but also separable discount rates, okay? So I would think that for Coca-Cola, that you probably wouldn't use an APV model, because I think that you're going to be able to apply a discount rate for the entire entity generally. And there's a lot published on Coca-Cola with respect to their discount rates as well. So I think you could do that. Now you might argue, well, we've got North American operations, we have South American operations, we have Asian operations, we have MENA operations, every place. So would we need to use separable discount rates? And I would say, yes, you could, but there's enough out there about a globalized discount rate for Coca-Cola that you could also just use that. I don't know that I answered your question.
No, you did. And I think I asked also because I know that I think other people might come along with that same question about, like, oh, I'm realizing, that this company I'm valuing or this project will have multiple cash flows. Does that mean I must now do an APV? And so, yeah, I think you answered the question.
Yeah, so I'm going to call you out on something here, since I already harassed you for using Coke. So you are great, and I say this with total sincerity. You are great at asking questions that other people ought to be asking, and just don't have the confidence to do so. And the rest of us are appreciative that you're willing to do it, because it gives me an opportunity to answer some things that I think are helpful for you all to know. So thank you for doing that, honestly. And go into rehab for the other thing, okay? All right. So any other questions before I move on to enterprise value multiples? We're kind of going to leave the whole discounted cash flow world behind for a little bit.
I've got a quick question.
Please, Emilio.
What's your favorite distressed company?
Oh, man. If you'd asked me that question in January, I would have given you a different answer than right now. If I could put together, and by the way, some of you that know me will be shocked at this. I think that in normal times, buying a restaurant is about the fastest way I know to lose money. Okay, it is a surefire way to some massive losses, unless you are extraordinarily talented, a celebrity or something. That said, if I could scrape together enough money to buy a strong restaurant group right now, I think there's enough distress that might not be a bad idea.
Yeah, because I for my project, I'm looking at distressed companies.
Cool.
I'm just wondering.
Look at a small airline. Look at a hotel chain. look at anything in recreation. They've been devastated. And most of them don't have enough cash or access to cash to not be interested in some kind of an acquisition at the moment.
Right, because I've been looking, just kind of perusing as of lately, and most top like whatever distressed companies are dominated by retail, but I don't expect that to change anytime soon. But they wouldn't be a good investment either. That's why I'm wondering. I mean, I agree airlines, because eventually there's going to be a turnaround. Same with entertainment and that sort of thing. But
yeah, you know, entertainment, airlines, anything in the food service category, you know, where they're dependent upon people going there and staying and in the social experience. I don't love retail because I think
they're in trouble. Yeah,
no
matter what.
In fact, they were in trouble anyway, and they just got in worse trouble because all of a sudden the speed at which we are integrating digital technologies to replace the brick and mortars has just escalated dramatically. Yeah. So to the extent I didn't like them before, I like them a whole lot less now.
I agree. Anyway, yeah, I just wanted to get your thoughts on that.
Yeah, so classify my answer there under, well, who cares? He probably doesn't know what he's talking about, but I gave it to you anyway. Okay.
All right.
Any other questions before we move away from discounted cash flows? So there are three generalized ways to value any asset. We can look at the asset's value on the balance sheet, which is its book value, right? We know that that's historical, and it may or may not have any relevance to us. We know that we can look at it from a market perspective, which takes the market value at which it last traded, or the market value at which something just like it last traded, and we can apply that to our asset, and we can call that a market value. It came from a recent transaction of some kind. Easy in the stock market, easy in the automobile market, easy in the real estate market. Harder, for sure, in the company or complicated asset market. And then we have production value, which is sometimes referred to as the income approach. So everything we've been talking about with respect to discounted cash flows, continuing values, discounted continuing values, and adding them all together, everything, APV, FCF, KVD, Gordon growth, all of that are various methodologies for discounted cash flows. But now we're going to enter into the market approach, and we're going to leave the income or production approach not behind, but aside for a moment, okay? And I want you to think about a market approach for a moment. I'm going to guess that some goodly percentage of you own a house, and some even higher percentage of you perhaps have purchased that house within the last few years or refinanced it. And when that transaction took place, an appraiser of some kind entered the picture, and you or somebody paid for that appraiser to do their job. Kang, do you have any experience in this either as a consumer or professionally?
Yes, as a consumer.
Okay. So when an appraiser appraised the property that was the subject property of your transaction, how did they know what value to put on it?
Well, they looked at comps in the area for a similar type of property.
Okay. So they looked at, go ahead.
Oh, no. Well, in the previous house, they looked at historically what the property also sold for.
Yep.
So a couple of data points.
Okay. So comps, they looked at square footage. They looked at number of bedrooms. They looked at number of bathrooms. They looked at area, right? They looked at condition, looked at all of these things, and looked at numerous properties on numerous comparable points, and made some adjustments and said, based upon all of these, we think the VO property should be X, right? What they did was they used an enterprise value multiple. And that multiple is the value divided by whatever units of measure they were thinking about. The value divided by bedrooms, the value divided by square footage, the value divided by bathrooms, or some amalgamation of those. Maybe they took some averages, some weighted averages, what have you, but they did that. That's nothing different than what we're about to do, and we're taking the enterprise value. And the enterprise value is synonymous with the estimated value. We can rearrange this. But first, let's go ahead and think of the 4 types of enterprise value multiples that are most applicable to finance, whether it's at the entire firm level or if we're parsing out the firm into a division or maybe just a project. Again, the enterprise value is the value. It's that present value we're estimating. It's our transactional value. Well, we can look at that in an EV sales multiple. So we can take the gross value of the company divided by the sales or the revenue, and that's going to give us some number. Or we can take that enterprise value, estimated value, and divide it by its EBITDA. That gives us a number. Or EV/EBIT, EV free cash flow. These are commonly referred to as a sales, EBITDA, EBIT, or free cash flow multiple. You don't need to reference that it's a multiple including the enterprise value because that is just a given. That's expected. So an EBIT multiple will always be enterprise value divided by EBIT. An FCF multiple will always be enterprise value divided by free cash flow. That's a whole group of enterprise value multiples. There are more of them. In fact, I believe that I have given you a quick sheet that lists a few more of these. So you see here these first 3 that I just referenced, and then the 5th one, and then there's yet another one that's EV no plat, another one that's EV invested capital, and another one that's kind of esoteric but is used in the SaaS industry where you have units of subscription. That's EV divided by units. It's not terribly useful in most conditions. And then we'll come back to these equational forms a little bit later. And these are asset-based enterprise value multiples. And then on this same quick sheet, there's some equity-based enterprise value multiples as well, which are a little bit different. And we're not going to spend any real time here. I give this to you because in your investment classes, this might become helpful. And I give the others to you, even the esoteric ones here, because if you come across them, I want you to have a resource to be able to adjudicate them and something to give you better or greater relevance of them. But we're going to focus on these 4, and specifically we'll focus on this one. Not because it's better, but because if you understand one of them, you understand all of them. And I don't want to go and talk about 4 different things and confuse you yet more than I've done over the prior 6 weeks. Okay? So these are not models. These are simply ratios. But from that ratio, we can re-engineer it or change the algebraic structure by multiplying both sides by whatever the multiple, M, whatever the multiple is. And we can say that EV divided by EBIT equals some M. If we know what EV is, if we know what EBIT is, then we can simply calculate what M is. Or if we know what M should be, and we'll talk about what should be means in a moment. If we know what M should be, and we know what EBIT is forecasted to be, then we should know what the enterprise value or the estimated value could be. And all of a sudden, we've gone from simply a ratio to what is a credible model. So let's think about this for a minute. I'm using some numbers out of Mira-Dravana. You won't necessarily recognize the EV here because this isn't coming straight off of the Mira-Dravana financial information you had, which showed a common stock price at 4 1/8 and a preferred stock price at 230. This Mira-Dravana case has brought the common stock value down to 2.3 and the preferred stock value to 1.15. I don't want to go into any detail at the moment as to why it is, but if you don't recognize this enterprise value for Mira-Dravana, that's why. Didn't come off of the problem set you dealt with, comes off of a revision of that. But if I look at that, enterprise value is calculated for the base year using those stock values, etc. And remember, it's enterprise value is the stock value, the debt value minus cash, right? Or it's the estimated value. Those should be synonymous. And I divide it by the EBIT for the base year. I get an observed multiple for that moment in time of 5.82. And if I can count on that multiple, then maybe I can use that multiple and apply it to a different moment in time. But all I've done is gone from this ratio to rearranging the equation, to elongating it out to solve for EV instead of solving for the multiple, and I'm giving you the exact same numbers here. So it's just a relationship until we turn it into a model. And I'll tell you, the model, the estimator, can be as simple as enterprise value at time 0 equals the EBIT at time 1, or EBITDA, or sales, or free cash flow, depending on which of the enterprise value multiples you're using, times whatever we have a reason to believe the multiple should be. And now it's a valuation model. I can take my EBIT from time 1, the first year of my forecast, and I can multiply that by some expected multiple value, and it's going to give me the enterprise value, or the estimated, or the present value of 198.36 as the time 0 value. So this is a little bit like the Gordon growth model, right? It doesn't look like it, but it's this broad brushstroke, kind of like the Gordon growth model. And I can apply this in the immediacy. Year 1 for the EBIT might be next year, not the first year of some other continuation that might be years out into the future, but it might simply be next year. And when you see on Shark Tank, or you're sitting in the boardroom or one of the boardrooms at Goldman, and people are using a multiple to think about something, this is what they're doing. It is equally as error prone as simply applying that free cash flow divided by WACC minus G and calling that good, as though the growth rate of the free cash flow is going to be constant throughout all possible time. It has the exact same error built into it, but similarly, because it's so simple, it is so commonly used. It is hands down, far and away, the most commonly employed valuation model. And anytime I do a valuation, not only do I include a free cash flow model exactly as you've seen it, but I also include this uber simplified enterprise value multiple model. And I use one other, which I'll bring to you in a few minutes. They help inform something, but they can be they are problematic in that I've gone from relatively complex in the free cash flow model to uber simple in this. And so I might have to reconcile, but maybe it's forming a range of potential values that I can then count on or utilize in the future. So just recognize uber simple, Gordon growth model-ish, and you'll see a little bit more as to why that is in a moment, but possibly problematic. Well, which kind of multiple should you use for what kind of company? And so I'm giving you here a very simple, in fact, oversimplified rule of thumb. So we'll use an EV sales, or sometimes thought of as EV revenue, for an early stage venture in which we have positive revenues, but we don't have positive operating results. Because we may not have positive operating results just because we haven't gotten up to speed yet, right? Or we're doing other marketing investments, etc., to where we just don't have a positive operating environment yet. But we have an asset that may have some real value to it. So early stage ventures, or I would tell you that maybe even a later stage venture that has some new life in it, that has some new dynamic of growth that's causing it to have a negative operating income, but still some good future prospects. We'd use the sales or the revenue multiple for that. The EBITDA multiple we would use for a firm with good operating income, so positive operating incomes, positive EBITs, but significant capitalized assets that are causing us to have to think about a reasonably robust depreciation, which is the DA part of this, right? The EBIT multiple, similar, but here we maybe have limited operating assets, so we're not as considerate of depreciation. We're less looking at operating income. And then the free cash flow multiple is a more mature company. It's got good operating results, but it also has the ability to articulate some balance sheet forecasting. So remember that the difference between EBITDA and free cash flow is some tax adjustments, of course, and some net working capital and fixed asset forecasting. Well, if we don't have a lot of capital growth needs, or we don't have much of a capitalized environment, or we don't know what our capital growth plans are going to be, maybe we use an EBIT multiple or an EBITDA multiple and not a free cash flow multiple. Okay? I'll go one more before I take some other questions here. So we might think about what the right model form is using a multiple. And here we've got the 4 examples. But we might also have to think about where are we getting that multiple from. Forget what it represents. Where are we getting it from? I might get one from my company's history. Casey alluded to this. I can look at its EBIT multiple. If I can look at the income statement and balance sheet, its value structure 5 years ago, and again 4 years ago and 3 years ago, I can look at an EV/EBIT multiple for each of those years if I have that data set available, right? It's just a ratio. But that history isn't irrelevant. It's hard for me to look at Vo Enterprises and believe that its future has no relationship to its past. That's not a realistic view, is it? But to think that we're constrained by our past, that we can't grow beyond our past, is also an unrealistic view. So history becomes one of the elements, and we might look to history, our own company's history, or maybe other companies' histories, for possible multiples that would inform us of what multiple ranges we should be using in our assessments. Or maybe I'm the president of Ball Incorporated, and Aragon comes in here and is thinking about acquiring the firm, and we have to look and see, well, I want to be as good, I want to be productive as Aragon Industries, but I'm not Aragon Industries. I'm the president of Ball Corporation. Come on, we operate out of Payson, Utah, for heaven's sakes. But maybe someday we can have the managerial prowess, the capital asset accessibility to get our operating results high enough that we can be an Aragon Enterprises, in which case maybe I've got an aspirational target. I can look at Jason's company, say its historical multiples, or maybe just the one this right now is X, let's call it 10. Well, my company looks like it's more like an 8 at the moment. And so I could aspire to a 10 times multiple, and I can use that multiple and its algebraic foundations to identify what we might have to do in order to become more like Aragon Industries. Think back to the DuPont analysis version of ROE. You remember the ROE is nothing but net income divided by total equity, right? But we have this DuPont identity that lets us say, well, we can rearrange it such that we're looking at profit margin times equity multiplier times total asset turns. And as managers and executives, maybe I can deal with the components of profit margin. And if I improve profit margin, I've improved ROE. Well, I can look at something similar within these valuation multiples, and you'll see that in a few minutes. So I can look at history, or I can have some aspirational target, or maybe I'm just looking at other companies that are like mine, these comparable values. Well, how would we do that? There are numerous published repositories of data that show public and private transactions over multiple periods of time, and let us look by standard industry classification code or an NAICS code. Excuse me. They come out of companies like Deal Stats, PitchBook, which is a name you might have heard of, Capital IQ from Standard & Poor's, Bloomberg's terminals from Bloomberg, of course. Duff & Phelps publishes one. There's another one published by Cognient Data. So there's plenty of information out there to help you know by business type, by industry classification, which you can drill down quite a ways on, of course. We can identify, let's say, over the last 24 months, how many restaurants or restaurant chains sold in the United States and at what multiples they sold. And we can see the profit margins for each one. We can see the total revenues for each one. We have a treasure trove of data. Well, if that's the case, now we've got comparables in the market. And we can say, okay, we have a restaurant group. Well, which one of all these other restaurant groups, or which ones of all these other restaurant groups that have transacted in the last couple of years, which ones does our company look the most like? Well, our company's got a profit margin of 14%, so we're going to look at those that have profit margins not unlike our 14%. We have an operating margin of 32%. We can look at those with operating margins, etc. We can bracket in, and all of a sudden we have comparable values. We may not know anything about our company's multiple other than its history, but if we look at those transactions that have happened with like assets in recent history, we are able to come up with a decent idea as to what should our multiple be. And then finally, there's an algebraic construction that we can calculate what a multiple should be by using its return on invested capital, its weighted average cost of capital, and its growth rate. So that's a broad brush, just introduction to valuation multiples. We're going to delve a little deeper here in a moment. Any questions about where I've been so far? I don't see your eyes bleeding yet, so are we okay? If Kang's smile a little bit, we must be okay. Because if Kang doesn't smile, I usually stop. The gig's up if I don't have Kang with me. Okay, so let's move on a little bit. I told you there are algebraic structures. So for each of the four models that I said that we'll focus on, you see the multiple in the left-hand column in blue, and you see its algebraic construction in the right-hand column. And I'll focus on this one, and I've given you both the left and right-hand sides of the calculation here. But this is the equational form of the EBIT multiple. I'm going to walk you through very briefly the algebraic proof that gets us here. To the extent that you want to use that proof, and some of you might if you're doing projects, I'm happy to spend more time with you on it. I just don't think it's necessary for everybody to become experts in the proof at the moment. I just want you to see that I can go from EV/EBIT and I can end up with this ROIC minus G divided by ROIC times WACC minus G, all times 1 minus T. These are the same thing when we look at the algebra. Let me show you how. We're going to start with this construction of a continuing value using the KVD equation. Notice that what I have here in this KVD equation is I have the KVD form of free cash flow in my numerator. And I simply divide it by WACC minus G. So I have a Gordon growth model here, right? Using a particular interpretation for free cash flow. And that estimates my value. Well, what is no plat? No plat is EBIT times 1 minus the tax rate. And I want to get to the point where I've got EV divided by EBIT. So how do I do that? Well, the first thing I can do is recognize that I can disaggregate no plat and rewrite the equation as EBIT times 1 minus the tax rate, then times 1 minus G divided by ROIC. And then I can divide both sides by EBIT. And all of a sudden, I have EB/EBIT as a multiple on my left-hand side. And I can then do some rearranging, and I won't go through the steps on this, but you've got it in the, you'll have it in the video, you certainly have it in the PowerPoint to look at, and I can end up at this ROIC minus G divided by ROIC times WACC minus G times 1 minus T. You might argue, why don't we simply use this? Why do we do all the rearrangement to get to this? And the reason is because I think it more visually helps us represent this issue of the relationship between ROIC, WACC, and G. You'll get the exact same outcome anywhere in this string. I just think that this bottom one gives us a better visual and conceptual understanding of what's going on with this. So this is simply taking and creating an algebraic construct to get to whatever this number might be. So rather than simply look at history, aspiration, or comparable, we may be using the company's own data. We can calculate a plausible multiple as well. And that might be very helpful for us at times. Any question about that? I didn't think so. Well, you're not going to have a lot of questions about this either then. And I'm not going to spend any real time here either. I give this to you simply because I want you to have it. I can also use this same equational structure. This I've got up right up here at the top is exactly what we were just looking at. And I can work this if I know what my multiple should be. And whether I know it from aspiration, target, history, what have you, if I know what my multiple should be, and if I know what ROIC is, I know what WACC is here, and I've got it at 15.35 in this case. If I know what ROIC is, and my tax rate, I should be able to reverse engineer this or solve for growth. And all of a sudden, I have another way of looking at growth. But what does that growth mean? You don't have to walk through this whole equational structure to know what that growth means. What you have to do is think about where we got these variables from. Let's assume this 5.82 is an observed multiple, which in our case it was, right? We took that from one of our earlier slides for Marriage Ravana in that base year for which I gave you the information. And we know for Marriage Ravana, this 17.59% is the ROIC. When we changed the stock prices, as we did to think about this a few minutes ago, it changed our WACC from 16.95, changed it down to 15.35. So we know ROIC, we know WACC, we know tax rates, we know an observable multiple. We can reverse engineer for G now. And it tells us that in order to attain this multiple or to support this multiple, given these other values for ROIC and WACC, the growth must be 9.5%. Well, fine. We know a number. What can we do with it? Can you think of anything we might want to do with this number? So let's think about this. So Casey comes and says, Rick, I believe that this company should be trading at a 7 times multiple. It has this ROIC, it has this WACC, it has this tax rate. And I look at that and I say, yeah, that's great, Casey. And I run through this kind of a funnel. And in order for this to trade at a 6 times or 7 times multiple, that means the G has to be even higher still, right? And I can look at this and say, you know, Casey, in order to justify that 7 times EBIT multiple, this company's got to be clicking along forever at a growth rate that averages more than 9.5%. For the multiple to be more than 5.82, the growth would have to be more than 9.5%. I just don't think that's plausible for the company at hand. Think back to Damodaran's early videos that I exposed you to. And remember when he talked about Apple and I think it was Tesla and maybe Ferrari. And one of them he said, you know, people ask me why I don't like the company, why I wouldn't invest in it. Because it's got these great prices in the market, it's got these great growth. He looks at it, he drives this kind of a number as part of his assessment and says, I simply don't believe that from my personal smell test, given my intuition, my experience in the market, I don't believe that that company is going to sustain an X growth rate in perpetuity. And all of a sudden, as an investor, I realize the market has overvalued the stock and I walk away from it. That's what Damodaran was telling you. He just wasn't using this perspective expressly to show you. But that's what Damodaran was telling you. So these aren't just some interesting algebraic wanderings that I might have. They're the underlying principles that serious investment analysts, stock investment, full company investment, private equity, venture capital sector investment, will be using to determine whether they should put that $10 million into Emilio's company. Any question conceptually about where I'm at the moment?
So when you have that multiplier and you're looking at around other companies, there's must be a time frame then that for acceptable multipliers with those other companies you're looking around at.
Yeah.
Is there like a 5-year timeline? Like I don't look past anything past that, or does it just depend?
Well, in this case, Scott, I'm not even using a time frame, am I? I'm using a very broad brushstroke, Gordon growth construction side of kind of thing going on here on the right-hand side, right? And so I'm not even using a time frame. Well, what that means then is what I've gotten here in my outcome is the average growth that this would have to experience over time. Well, I mean, throughout all time, not just over 5 or 6 or 8 years, throughout all time. Well, let's think about Marriage Ravana for a minute. We know that Marriage Ravana is expected to have a 10% growth rate for the next 5 years. And I think we settled that down to 2.5% thereafter. Well, as it turns out, when you put all of that together, it's representative of about a 9.5% rate using the ROIC and WACC for our base year. Now, we may have to think about that. If all of these numbers came from our base year, then yes, this number is telling us something about the pricing and this eternal, perpetual growth rate, but it's also very heavily influenced by the experience of that 1 year, isn't it?
Yeah.
I don't know that that answers your question, but it's as close to an answer as I can give you, Scott.
Okay.
Okay. Let's move on a little bit further, and then we're going to apply some other numbers to this with the Mira-Dravana case. So let's come back now and remember that we have single stage models, which is what we've been looking at here, right? This is all a single stage model, right? Oops, excuse me. It's all a single stage model. And we have multi-stage models. And in a multi-stage model, we can be a little more finely tuned. I don't have to apply this broad brushstroke thing right now. I know at a point I'm going to generalize. When I put a continuation value in this, a terminal value, when I go into my perpetual wanderings, I know I'm generalizing. I generalize very broadly with a 2.5% growth, right? But between now and the time I get there, whether it's 1 year, 2 years, 3 years, 5 years, 7 years, I know I've got some more finite data that's a little more granular. And maybe I can make it very granular. Maybe the growth rate of my cash flows and my forecast is different for every calendar quarter for each of the next 5 years. Or, as we've been doing, I might have just given an average growth rate for the next 5 years. This can be as granular as you want based upon how detailed you're willing for your forecast analysis to be. We've been very broad because we have 7 weeks to climb a mountain together, right? But in this case, I can have a model that is referred to as the forward market multiple model. And it uses a combination of the present value of the discounted cash flows and the present value of the continuing value. You've seen this a dozen or more times now. And here is the structure of the present value of the discounted cash flows. It's exactly as you expect it to be. But the continuing value now is different. In each of the models I've shown you, the only thing that's different each time is the continuing value. The models are identical otherwise. It's the continuing value. So remember at the beginning of the course, I told you that a lot of these things are going to look like they're terribly complex and just floating around out there in the ether, when in fact, they're not. It's all about forecasting and recognizing different continuing values. Everything else is the same.
Yeah, so just as a point of reference, Rick, so like all the homeworks that we've done over the last couple of weeks that involve us making a table, getting a free cash flow, and having those things at the bottom, continuing value, that's the only thing that really ever changes and that we have to know how to change when you switch from KVD to FCF to FMM now. The only difference with this one is you need to know which FMM you want to use, which was a couple slides ago. Like EV,
yeah, we'll come back to it too, but that's exactly right. Where are you getting that M from?
Yeah. So like a new company, brand new company, you said EV over sales. That would be your FMM in here for your CV.
Yeah, and that would be my multiple.
Yeah.
Yep. That's exactly right.
That's what we have to interpret for this week's assignment. And also, like, if we want to use this model, you have to know how to get that market multiple.
Yep.
And you just plug it in for CV.
And you can get it through history. You can get it through aspiration. You can get it through comparable values, or you might even be able to calculate it algebraically. And if you're terribly astute and are doing a very deep dive analysis, you're probably going to do all of them and then try to identify which is most plausible for the company and scenario you're looking at. So good point, Casey. Thank you. So we take the continuing value, of course, which we have here in the numerator, and divide it by 1 plus WACC to the T to get the present value of it. And that gives us our forward market multiple model. Now, I should disclose to you that this term forward market multiple is not a commonly used term. There isn't a commonly used term for this model form. Sometimes I hear people refer to it as a hybrid model. but that could mean many things. I coined this term, so if you see this published any place, and you will in a few places, it's a term I threw at it. It just made sense to me. This is not going to be found in a finance textbook. It's simply trying to help us understand we're using a market multiple, but it lives forward in time. We're going to have to discount it back to today, just like we always have to do, because it's a continuing value. So here's an example coming out of Mirage Ravana. In fact, I'm going to move to the Mirage Ravana spreadsheet rather than just showing you the numbers here. I think it'll make sense. And this, by the way, should be pretty familiar to you at this point because you've been all over these numbers for some goodly amount of time. Can you see these well enough? Can you see these numbers okay? I think so. So all I've done, you recognize this forecast. This is the forecast that you've come up with recently, all the way through ROIC without adjustments. And you recognize forecast ratios. Hopefully you will have read my comments on your graded Excel assignment from this last week. Some of you just nailed these spot on. Some of you have some adjustments to make in your models, okay? And I would encourage you to read my comments on that, on your assignment, and make the adjustments before moving into this next week's spreadsheet assignment, because it's where all of it comes together. This is the culmination of the entirety of your model now. And so here I am looking at the forward market multiple construction, and I've used a target multiple of 5, which we'll talk in a moment as to why I didn't use 5.82 or some other number. I've used a target multiple of 5. And so you notice that the present value of my discounted cash flows are the same all the way across, right? No difference there. The continuing values are where we see the differences. And I'm going to go ahead and just get rid of this for a moment so I'm not giving you the confusion of APV and its different discount rates. Just be looking at these 3 side by side. So the present value of the discounted value is the same each time. The only difference is in the continuing value. And where I got this is I took and multiplied this target multiple, don't even worry about how I got it yet, by the EBIT in the first year of the continuation term, because the continuation term always uses the next cash flow interacted with something. So not only are the other model elements identical, but something else that is common for all these models is they're all based upon the next cash flow instrument. Whether it's EBIT, no plat, free cash flow, it's always the next cash flow instrument in our time 1 or the year after our explicit period. So I find it, and then I take the present value of it, the exact same way you would take the present value of anything. I take its value, dividing it by 1 plus my discount rate to whatever exponent of time. And then I add those 2 things up, and it gives me a value, which in this case, the value of 173.8 is pretty similar to the value of KVD and the value I find in the free cash flow. So now we have to think about, why is it similar? Well, it's similar because the present value of the discounted cash flows are exactly the same. And it's similar because I chose a multiple that would reflect it, that would cause it to reflect as similar. So what this tells me is if the model form shouldn't make a difference in the outcome of the value, that I must have to think about a multiple that gives me about the same value. So I can change this. I could make it a 6. Well, I can't use 6 because it makes this 198. I could use a 4.25. Whoops. A 4.25. And again, it gives me a different, so I converged on 5 here. And you might say, well, Rick, that's arbitrary. And yes, it is. I am kind of doing a self-serving exercise, but there's a reason for it. Because when I input this multiple of 5, and then I run the G solution, that G solution is what we're doing here in the spreadsheet, in the equations to come up with my solved G. So this is my G solution. When I use a multiple of 5, my G solution is that to justify that multiple, this company must have an average growth rate of 4.65 in perpetuity. Well, I can believe that if the next several years are 10, and then I have assigned it about a 2.5, which I know really is going to go from 10 to 8 to 7 to 6 to whatever, and it's going to converge in something even lower than 2.5 in perpetuity. I can believe this. I don't know that if I put 5.82 in here, I don't know that I can believe that. I don't know that a growth rate of 9% is plausible to me. But I observed that multiple in 1 year, didn't I? The base year. So now we have to think about how do we adjudicate history. Before I move away from here to think about history, any questions as to how I constructed this model form?
Do you mind clicking on the CVFMM again? I just missed that.
No problem at all. It is so simple it's deceptive. Literally take whatever the target, aspirational, historical, whatever multiple, and multiply it by whatever its denominator's value is for the next period. In this case, its denominator's value was an EBIT, right?
Yeah.
So literally, it would be EBIT at time 1 times whatever my multiple is.
Okay.
The trick here, Nate, is in targeting the right multiple. And I created one here to get it to converge with the others, which tells me something. I know that for these two values to be accurate, this company has to have a growth rate of about 4.5% in perpetuity. Well, I don't disbelieve that. There's nothing implausible about that. But if one of these other numbers here on the left had been in the 200 range, I might have needed a multiple of 6 to get there. I don't believe I'm going to have that kind of growth. I just don't buy it in perpetuity. And you might say, but we saw it. We saw the 5.82. Come back to this. We saw a 5.82 multiple in our base year. So let's look at this. You'll remember our financial sheets. Here I've changed the stock prices, as I told you a few minutes ago I had done. We'll talk next week as to why I did that. But you'll notice here that that ends up giving me an enterprise value, the way that we normally calculate enterprise value, market cap of the stock plus market cap of the debt minus cash. And I divide that by EBIT, and it gives me 5.82, so I observe it. Well, that 5.82 apparently is going to require a growth rate of about 9% to pull off long term. Is it possible that the growth coming into this 1 year from which I observe these numbers, is it possible that that growth is higher than it's going to be in perpetuity? Well, of course it is. In fact, it's not only possible, we see that that's exactly what's done. So maybe I should think about anomalous periods. What if this ended up at a 10, let's say, instead of 5.82? Well, that would have been a big growth year, right? Maybe in order to use history, I don't just look at one moment in history. Maybe I have to look at the last 4, 5, 6, 10 years of history. Maybe I have to average them if I have some anomalies in there. But in each case, I can do some pretty interesting analysis here. I know that to justify that 5.82 multiple, I've got to run growth at 9% in perpetuity. I just don't buy it. 5, yeah, at a 4.5% growth rate, 4.65, I don't disbelieve that. Now I look at the company, the industry it's in, the expected demand for that. I look at some of my explicit growth. I look at where it fits in the whole macroeconomic condition, and maybe I buy that. Other questions about how we got to where we are? Okay, so let's go a step further. Whoops. But not much further. We're just about there. So these are the numbers that you're seeing. Just walk through all of these. Then ask a question. So should we value the firm at 194.39, which I did at the 9.52% rate in the 5.82 multiple? Or should I value it at 173, knowing that that was at a 5 multiple and represented a 4.65% growth? And I think the answer is found in what Demoteran told us, the very first assignment of the block. Is that a plausible level of growth? Remember, is it probable? Is it possible? Which they conspire at plausible, right? That's where he started for us. Is it probable and is it possible? Those conspire at plausible. Does it make sense? Well, if you don't know anything about the markets, if you don't know anything about finance, you don't know anything about the company and the industry it's in, you can't even tell. So remember at the beginning of the term when I told you that I knew that you all wanted to have multiple six-figure incomes. Some of you probably are already there. In fact, I know some of you earn over $100,000 a year as it is right now. But I think all of you are in this to drive an income level that's higher than the one you have today. And that you all see yourself as having a multiple six-figure income. And by the way, my guess is you're right, you will. But that a monkey and an iPad could do what we've been doing together the last 6 weeks. So what's the difference between what a monkey gets paid and what Nate's going to get paid as he's the consummate professional? It's not his ability to do the metrics. It's his ability to know whether a 9.5% growth rate is plausible or a 4.5% growth rate is plausible, which is the difference between a 5.82 multiple and a 5 multiple. Any questions about that? Okay, part of that silence is eye bleed, okay? You see a little bit of bleeding coming from the eyes at the moment. But part of it is because in your mind, you're thinking some of this is too simple. That continuing value construction is just too simple. EBIT times some multiple. And you're right, it's exactly that simple. The biggest error I see people make at this point within the work that we're doing is by trying to make that harder. Notice that it isn't EBIT times the multiple divided by WACC minus G. It's not that at all. In fact, EBIT times the multiple should equal the free cash flow divided by WACC minus G. They should give us the same continuing value because the rest of the equation is the same. That way they would give us the same value. And if we think about that, that comes back to our whole reverse engineering and being able to go through and calculate what our growth rate is and then say, is that a plausible rate of growth or is it not? Remember the decision criteria of net present value, internal rate of return, modified internal rate of return, etc. Well, now we have another decision criteria, and that is having estimated perpetual growth, is it plausible? Does it pass our smell test? When Vo looks at it, when Kane Vo looks at that, does he say that's plausible or does he just giggle or shake his head in bemusement? And you have that intuition to some degree now. You'll have it yet more so as the years and experiences unfold.
So Rick, you're sitting at the table, right, with those two values,
Yeah.
And you're looking at one another. I mean, there's quite a bit of disparity there.
Yeah.
And again, it's kind of in a I can't remember what Mirror Nirvana is, but do they ever so what?
Okay.
You know what I mean? So
Sure.
I got this number, and you got this number.
No problem.
Are we going to walk away, or where does there's an art of negotiation that ensues at some point.
Sure.
I'd imagine.
No, I agree. So let's look at these models alongside each other again and remember what they're telling us. We get these values of about 172, 173 with each of the model forms, right? So it's telling us that they give us the same outcomes, which means it's telling us they're built on some of the same growth factors because ROIC, WACC, the cash flows are all the same. The only thing that can be different is a growth factor somewhere, right? And the growth factor is built into whatever that multiple is. That's how we can reverse engineer it to find growth. So these numbers are different, but only tiny bit different because they're all using the same cash flows. They're all using the company's WACC, and they're not using any adjustments. So let's take it to the adjusted for a minute. And let's make the assumption that I'm not using WACC now. Let's say that I've got an expected return of 17%. Okay. So I'm a prudent investor. I'm an objective investor. I know that the weighted average cost of capital out there in the market for this kind of company is 15.35. That's what we just saw before I overrode it. But I expect a 17% return. Well, all of a sudden, my 17% return and some tiny little adjustments tell me I've got something that should be worth closer to 185. But those adjustments give me some notion of growth as well, don't they? So I'm going to have to input some number over here to think about my growth. I don't want to do that at the moment. Well, yeah, let me do it. Let's see, where am I going to converge? About 4.35. My numbers are getting pretty close to each other. At 4.5, my FMM value, my free cash flow value, my KVD value are virtually indistinguishable. But it tells me that with these improved cash flows because of these adjustments and the growth that gives me all of a sudden in my cash flows, that I only have to see an 11.61% overall growth rate in this. Well, the growth rate's coming in large part by the virtue of these adjustments I'm going to introduce to the company. It's not my perpetual activity. It's not all my regeneration. It's my adjustments that get me there. So what's plausible? Well, I know the company wants 173. I can afford, if I can make these adjustments, get this kind of growth, and have my own discount rate here at 17%, I could afford to pay 185. And I still walk away with a 17% rate of return. I have created a range of values from the perspective of the business owner all the way to the perspective of the investor who wants a greater return because they're putting in something more than simply their time and talent. Excuse me, they're putting in something more than just their money. They're bringing relationships to the table. They're bringing managerial prowess to the table to get these improvements. They expect and should reasonably achieve more than the discount rate. I don't know that that answers your question as finitely as you might have liked, Jason.
No, yeah, I was looking, I guess, for context of what, what now?
Yeah. So we'll delve further into this next week because now you guys have the models.